Welcome back guys to another Zero DTE video, and today Ernie's going to be discussing premium decay, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
Normally, when you put on a trade like this the night before, these butterflies are sitting outside of that gray area. So that higher volatility actually gave us better pricing.
Is that what volatility usually will do, is make better prices?
Yes. What volatility does in general is suppresses the decay of premium. And that's particularly powerful on that very last day or that last session, because that's when most of the premium is still available. I guess you would call this the last 20 hours of the market, the last 22 hours. You still have about 75% of the premium that existed in the entire life of this option still available. That's one of the cool things about trading zero DTE. And a lot of the reason why we trade at certain times because of the change in volatility that often happens in that last 15 hours from before market reports and the overnight action with the European Open that happens at 3 a.m. And then you usually have economic reports at 8 a.m. And so there's a lot of stuff happening. And if the market drops or if there's impactful reports, that volatility can really shoot up, and that can give you better pricing on your options. As a general rule, volatility on any odd day tends to be higher in the beginning part of the day on that zero DTE day. And that's one of the reasons why we tend to suggest that you trade or open a trade in the morning, because it gives you that extra slight advantage on average. Now, it doesn't happen every day. And that's one of the reasons why I say you have to have situational awareness. You want to see what happened overnight, see if there are economic reports coming out, and is that affecting volatility? Now, I don't even have to look at the implied volatility indicator to know whether or not volatility is addressing it. I can just tell by where the trade's set up. And the fact that these things set up inside of the expected move tells me that there's increased volatility. But of course, just showing you the indicator, that was a confirmation. But that's something that you'll learn over time. You'll be able to say, this is really weird. Why am I able to put on a butterfly that's 2 or 3 strikes wider than I usually put, and it's closer to the market? And that's because there's lots of volatility, implied volatility building up. Of course, implied volatility, or what I'm just looking at, is the volatility for right now. That is all relative to the overall volatility of the market. So what I mean is, you look at the VIX and where the volatility is there, it's generally low. If we were in high volatility, you would find that these would probably come in even further, or we'd be able to put on even wider ones at the same spacing with the same pricing.
So to paraphrase what you're saying is it only gets better from here.
Yeah, whenever there's higher volatility, it's just better.
We've been in low volatility for almost 3 months now.
It's horrible.
And you're saying that as the volatility goes up, the pricing will get better. You'll be able to put on wider things for lesser money, etc.
As an options trader in this type of market, it's why option traders love volatility. They like running into the fire, and expose themselves even more, because it's going to be a lot easier to trade, which sounds counterintuitive to most traders. They want to run away from volatility. They think it's bad. But from an options trader point of view, it is just way easier to trade, less gamma risk. You can expose yourself much more with less risk. But this low volatility just sucks. It's painful. And that's why I recommend contracting your positions, getting smaller, because there's really nothing to grab, and the gamma risk is high, and there's no meat on the bone. And that's because low volatility accelerates the decay of premium. So going into the zero DTE, you're coming into zero DTE with less premium in the options. Another way to visualize that, I have a picture of it down here. So I'm sure you've seen a chart like this that illustrates the decay of premium over the life of an option. Are you familiar with this?
Yeah.
So in low volatility, that decay of premium will look like that green line. In high volatility, it will look like the blue line. The purple line would look like the normal case, or I guess medium volatility. So you can see how it suppresses the decay in the blue line in high volatility. And in the green line, it's showing how it's increasing the rate at which premium decays. So when you're coming into that final day, there's less of it. There's only this much as opposed to this much. Does that make sense?
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.